Shares of two prominent TSX-traded gold producers are down today. IM Gold and Eldorado Gold both have recently reported results. Let's get some perspective on the stocks and the sector. We're joined now by David McAlvany, CEO and Portfolio Manager at McAlvany Financial Group. David, thanks a lot for joining us. It is notable that during a period of time when gold seems to break through new record highs every day, and everybody seems to be on $3,000 watch now for gold, that it doesn't seem to take much for investors to turn sour on shares of a gold producer if that producer disappoints in expectations. Let's begin with IM Gold, first of all. What is the market concerned about there?
Well, I think both with IM and Eldorado, you're dealing with, qualitative issues which do matter. And particularly at this phase in a gold bull cycle, we would define quality as management, asset quality, and then, of course, the jurisdiction. And, you can see some sort of penalty in terms of performance based on, I think, largely jurisdiction. Looking at Eldorado, down 7% year to date, versus an index that is up double digits, whether it's GDX or HUI, whatever you want to reference. And, similarly, underperformance with IM Gold, up 14% year to date, but still 70% below its all-time highs. And I think when you start to look at West Africa, Turkey, Greece, this is not Canada. This is not North America. It's not tier one. And I think at this point, it does continue to pay to focus on quality. And again, across those three categories of quality, jurisdiction being one of them for sure.
So every day, an investor investors who want to be exposed to gold have a choice to make. How do they achieve that exposure? And one simple way is to buy an ETF that tracks physical bullion or futures traded bullion gold. The other most obvious way is to gain exposure to companies that mine gold, either by buying individual stocks or an ETF that tracks an index of gold mining stocks. What is your view of that choice? I mean, for a while now, the winning trade has been the metal itself.
Yeah, the winning trade has been the metal itself, and I think 2025 and 2026 will be the breakout years for the miners outperforming the metal. And I think what you have to look at is who actually is benefiting from a free cash flow standpoint, and who's benefiting in terms of capturing additional margin expansion in this move up in bullion. Yesterday's a great example. Newmont blows out all free cash flow records, which is wonderful, but they guide for 2025 all-in sustaining cost that's a couple $100 higher than the market liked. Not a surprise that they're selling off and under pressure today. This is an operationally difficult business. If you can check the box in terms of being in a jurisdictionally friendly place, then I think you're mindful of all-in sustaining costs. That's an important aspect. And going forward, who's going to capture most of the benefit from the bullion? Who's going to see that proverbial leverage, operational leverage to the upside? And so I do think that there's companies that, make sense. Lundin would be an example of very low all-in sustaining costs, not optimal in terms of a jurisdiction, not particularly a fan of Central America, but again, if you're looking at quality management, it checks that box. If you're looking at a quality asset, it checks that box. It's just the jurisdiction that doesn't. But again, all-in sustaining costs, if you can stay under 1,000 in terms of all-in sustaining costs, isn't it a beautiful world to be at nearly 3,000 on the bullion price? There is a cash cow, and there's others like it. But I think being mindful of the all-in sustaining costs is super important. I think that's what makes Newmont very intriguing from a 2026 perspective as they improve margins throughout 2025. They've done a marvelous job of selling off their non-core assets in 2024, and they are lined up to be an amazing company in a portfolio. A little disappointing to see that they haven't gotten further ahead in terms of their margin story for 2025.
Okay, so you've talked about Newmont. You do own Newmont, I see. You also own Alamos Gold, Agnico Eagle Mines, and B2 Gold. We're running out of time. We're not out of time yet, but we're running out of time. What are some of the characteristics that those three companies and stocks share?
Well, I think an important characteristic, particularly with B2, is that they fit that jurisdictional, no-go zone in terms of Mali. But as they move from a huge asset there to a huge opportunity in North America, I think as Goose comes online, you're talking about a transformed company. And so I think you're really talking about, if you wanted to even put it in terms of a turnaround story, very attractive, great assets, great management. And as they shift their production profile to North America, very intriguing. Alamos, I mean, yeah, great assets, great management. Newmont, Agnico Eagle, the very best management and some of the best assets in North America. I think, most of what they have is largely priced in. They're trading at premiums to net asset value, reflective of checking all those boxes in terms of quality. So they'll need something of a re-rating. I don't know that we'll get that in 2025. So Agnico is a leader, probably boring this year, but gosh, what a great job they've done thus far.
David, thank you a great deal for a good conversation. David McAlvany, CEO and Portfolio Manager at McAlvany